Welcome to Treasury Peer Trends Summer 2015. I've been swimming around in this ocean and it was usually lots of global international banks. Now I can't find anyone. I find banks, but they have either returned to their birthplaces or they hide behind a rock or in some seaweed. And that's a problem for us corporations because we want to have global, scalable operations that are cost efficient and streamlined. And that's not possible anymore, especially not in this area. And the consequences, firstly, is that we need to start to decentralize cash management into local hubs while maintaining the control centrally. Secondly, we likely will need to have even more banks in our relationships. And thirdly, we need to consider if there are other suppliers that can help us so we can maintain a more bank agnostic system.
People management always ranks high in our surveys. Last summer, 2014, the financial markets were pretty calm and focus was on recruiting and retaining staff. This summer, 2015, we have got used to high volatility and big risks, and we are now experiencing the banks continue to withdraw from major markets. Our focus is therefore on how to organize our operations, and especially the division of roles between central and local operations.
One issue is obviously risk management in this volatile environment, and policies, hedging, methodologies and so forth is fairly okay. We are looking though for ways how we can automate scenario analysis, since the rate effects are many times pretty high on the results. We need to be able to do scenario analysis, and many peers are still confined to using Excel to do scenario analysis, which is very cumbersome, and we are looking for tools to automate that part.
What are you doing, Magnus?
Well, I think we give up on regulation. Take it as it is. It doesn't provide any value for us. So, yeah, let's leave it. IT is 50% of Treasury, so of course IT comes up on the trend list. Besides implementing and upgrading Treasury management system, there are still a lot of gaps in the transaction flow. So there are smaller suppliers that are filling certain gaps. One is bank account management, the signatory rights for bank accounts. Another one is bank fee management, which is keeping control over what kind of fees you are paying to each bank and understand how you can share the wallet. And also to control that the contracts are fulfilled from the bank so you don't pay too much. Another area we are looking into is the payment experience of the customer. If you think about it, if you go into shop, how much time do you spend paying and how much time do you spend shopping? Now, is that becoming a treasury responsibility to make the payment experience from the customer much more pleasant and fast? And how many customers do you lose because the payment takes too long and is too cumbersome? Now we come to supply chain finance and working capital, and that is an issue that we always discuss. It's in a paradigm shift probably now, because we have this tendency of postponing payment terms to suppliers. Meanwhile, the government has realized that it's the small companies that actually provide jobs, so they are implementing prudent payment agenda. And of course, while decreasing the working capital, the companies get more cash and where to invest the cash. So there's a lot of questions and where and why and how in supply chain finance, and probably that's the reason why it is so very interesting right now.